Hello again from Core Wealth in Cape Town. We are going to be covering what happened in the month of September. Spring has finally arrived after much rain in Cape Town, and we'll have a look as well as what happened so far in 2023 because we're 3/4 of the way through the year. So the big story again continues to be interest rates and how that's going to be used to quell inflation. A number of the central banks like the US, UK, Switzerland, Japan have all signaled that they might be getting to the top of their hiking cycle. However, the question is how long are they going to pause before they start reducing interest rates? So you're going to get this sort of plateau picture where interest rates have been going up and now they're going to go sideways. And the longer they go sideways, the more nervous the market gets. The market likes falling interest rates. So we've seen the markets come off on the back of this concern. Another thing we saw this month, emerging markets, although they did better than the developed markets, they were still down for the month. China was a big contributor to that negativity. But one of the things that affected the developed markets was that China announced that no iPhones may be used in any of their government offices, and therefore we saw the Apple share price take quite a big hit during the month, losing some 200 billion in market cap. So in South Africa, inflation is actually behaving itself relative to the rest of the world, quite neatly within the range that the Reserve Bank prefers. On the economic growth side of things, we've just signed, the government signed agreements with China for some manufacturing deals where South Africa exports to China, and also for deals where China will be investing into South Africa, both positive for economic growth. And then on the load shedding side, we've seen Kusile Unit 3 come on board, and that means that that's one stage of load shedding just on its own. And then also the figures have been coming out as to how much solar energy has been put in place by the private sector in South Africa, and significantly ahead of what we've seen in previous years. And so again, further impetus to have sufficient electricity to actually drive our economy forward. So September was quite similar to August, and as you'll see from the slide, a lot of red down the month across the different global markets, and the equity markets losing between 4 and 5% for the month. If we have a look, however, over the last year, you can see that some strong returns over the last 12 months, but most importantly to actually have a look at the 3 and 5 year numbers, and there we can see developed world equities doing very well, particularly the US and the UK equities over 3 years, and then emerging markets have fallen behind, but we'll talk a bit about how that affects our outlook later on in the video. So having a look at South Africa, quite similar to global markets, although these returns are in rands and the previous ones were in dollars, we can see that the South African equity market again down in September, similar to August, but the 1 year return is quite healthy, and then the 3 and 5 year returns on the equity market also looking quite good. Interestingly, the rand actually strengthened a little bit during the month of September, but that has more to do with what's happening in the dollar rather than what's happening in the rand. So we're going to have a look at our different investment strategies from youngest to oldest. So we'll be starting with our sterling or UK pound global strategies, and here we can see we're showing over the last 3 months, these strategies have performed significantly well compared to their peer groups, adding some really strong returns. Over the last year, some slight underperformance in the defensive and balance categories, and then since inception, which at the end of October will be a 2 year period, we can see that we've had some really good outperformance. Even though the absolute returns are negative, since inception we've outperformed our peer groups really strongly. So having a look at our global US dollar strategies, they'll have a 7-year track record in November. We can see that green across the board, and so again some significant outperformance of the peer groups, which are international peer groups, and so very happy with the way this is performing. Some of the bets that have paid off of late have been our exposure to Japan, and being slightly underweight the US, which has helped us over the more recent period. And then our managers, the actual managers that we've researched and chosen, generating some good outperformance. So our oldest strategies are those that are focused on South African based clients, and as you can see from this list, that there's a lot of green. We've managed to outperform our competitors really well over virtually every period. some of the strategies, or 5 of them, have already got a 10-year track record and showing again some good outperformance. What has been good for us to see in the last year and 3 years is that we've generated some quite large outperformance of our peer groups, and the absolute number, the returns, are healthily into double digits, which means that our clients' wealth is growing quite substantially as you get those good real returns. If we have a look at equity markets around the world, they really like it when yields or interest rates on bonds are low. And this slide that I'm showing you now shows that at the moment we've actually seen this blue line in this picture has spiked, and this is the 10-year yield on bonds. The yield on 10-year bonds in America is back up to levels that we last saw in 2007, some 16 years ago. The simple thing we wanted to say with this graph is that we think the yield environment globally is not going to be the same as what we saw over the last 10 years. Now, what does that mean? Just like households, if a government spends more than they earn, they have to go and borrow money to make up that shortfall. And what we show in this graph here is historically where the US government has had a deficit. In other words, the grey line is above the horizontal, or they've had a surplus. In other words, they've earned more than what they've spent, and the grey lines are below the horizontal. Then on top of that, the blue lines just show how much interest they've had to pay on the money that they've historically borrowed. What the big question is what is this going to look like in future? And we can see the projected lines going forward from 2023 onwards show that there's going to be a persistent deficit, spending more than they're earning, and because of that their debt's going to balloon, and you will see that the interest that they have to pay every year becomes higher and higher and higher. The result of this is that you end up as a government with more debt, and what we're showing in this graph is how the debt looks as a percentage of your overall economic activity. And we can see there that in the US that has been going up, so they've got the debt in the economy is actually equal to the size of the economy, and that's predicted based on the previous graph to continue to rise in the coming years. So what does this do to yields in the market? On the one hand, you've got the US government saying, I need to issue more debt because I've got these deficits that I need to fund. Therefore, there's a larger supply. Where there's an oversupply of something, of a bond, its yields go up. And on the other hand, historically, the US government, as strange as this might sound, was actually buying its own debt. They were buying its own bonds. They caused demand for those bonds. And that is no longer the case going forward. And therefore, we'll see demand dropping. So higher supply, lower demand, we expect bond yields to go up. And so what is that going to do to global markets? To answer the question, we show this graph which shows the NASDAQ, the more growth-orientated and tech-orientated stock market in the US, the orange line, the blue line being the real yields in the US. And essentially, as the blue line is trending downwards, we see the orange line goes up. And conversely, as the yields start to rise, which is what we're expecting to happen more and more in the future, you see the orange line coming off. This has changed, however, in the last couple of months of this year, or basically in 2023. So that relationship that we've just shown in the previous slide broke in 2023. The yields have continued to go up in the bond market, but the equity market has gone up and not down. And that's what we're showing in this graph, where we've inverted the bond yields, and it actually shows that the graphs should be following one another, but actually they've gapped in 2023. And this was on the back of all the excitement around artificial intelligence. We think this is a risk going forward, as bond yields are going to continue to stay high and may even go higher, as we've just explained earlier. And based on that, valuations on the stock market are too high and probably will reduce. Now, that was talking specifically about the US markets. What we've shown here is research that we look at across all different equity markets around the world. And the way these graphs work, without going into too much detail, if the block on the graph is green, it means it's lower than its long-term average, or it's cheaper. It's an attractive point to buy at. And if it's red, then it is more expensive than its long-term average. And the bigger the block, the Either if it's big and green, it's very cheap. If it's big and red, it's very expensive. And we can see here, if we just look at most of the graphs are green, or most of the regions are green. US equity stands out as particularly expensive, particularly the large cap equities or the bigger companies. Netherlands is also quite expensive, and there's one or two other markets. But you can see there are plenty of spaces where markets are looking cheap. Japan, the UK, areas of Europe, particularly emerging markets. And that, we think, bodes well for the longer term outlook of an equity portfolio that's well diversified across those regions. The world continues to be exposed to lots of turmoil, whether that's another war that's recently, at the time of recording, just broken out in the Middle East, or whether it's inflation that's ahead of expectations. That turmoil will constantly be there. We don't expect it to disappear. The point is that to have a portfolio that's well diversified and has got exposure to growth assets for long-term returns. And if you do that through turmoil, whether it's a global financial crisis, COVID, and everything in between, you can generate long-term returns and ensure that your wealth is growing. Thanks for watching. If you have any questions, as always, please give us a call.